All right, we are live for a Wednesday RTD Q&A, and I'm excited to have a returning guest, Mr. Jeff Nielson from Dynamic Wealth Research, returning guest. So, Jeff, how you doing, my friend?
Doing pretty good, thanks.
Well, I appreciate you taking time to join us. As I mentioned, it's been a while since we've had a chance to connect, and so let me say, I just actually look at the date here, and it's been, let me see, pull this up real quick. It looks like it was back in 2016 since we last connected, and I titled that one, "The Dollar is Already Dead." And so here we are 5 years or so later. And since then, a lot of things have transpired, but curious to get an idea as to how things your way, how you've been doing. I know you've been a very busy man. For those that might be just coming across you for the first time, give us a little bit of, I guess, your background and what you're up to these days.
So, academically, I studied economics and law, which it gives me a good sort of foundation for being an analyst. And so, I've got some firsthand understanding of economics, which, trust me, it's a big advantage because a lot of smart people who haven't been formally trained in economics, unfortunately, they pick up what they know from the conventional economics, or economists rather, and they're basically a pack of charlatans. So it's really hard for people who haven't gotten the firsthand training to get properly informed about economic dynamics.
Right, understandable. So most people, not majority of the people is in the alternative media space, but a lot of other individuals, the overwhelming majority, pay attention to the CNBC and MSNBC pundits that go on and basically read off teleprompters and tell you what you want to hear, as rather than what's really going on. So there's all types of things happening. And since we last spoke back in 2016, quantitative easing came to an end for a short period of time. They couldn't stop it for long, and it started back up in 2019. And here we are now, and I guess the Federal Reserve talking about getting ready to dial back a little bit, but they can't fully. All these different things we're being told. So give us your assessment on where we're at right now from a macro, and then just hone in to the domestic economy here in the U.S. as well as perhaps even in Canada as well. Where are we at now?
I mean, the situation could not possibly be more dire. So I'm certain, even when we were talking last time, that I was already raising the specter of hyperinflation, because the previous financial crisis, the 2008 global financial crisis, that led to a hyperinflationary surge in the monetary base of the U.S. dollar. And when I say hyperinflationary, the charts of Ben Bernanke's currency creation, they were vertical, and so if you want to understand how much worse things are today, we can probably start by pulling up the chart of the M1 money supply, if you don't mind.
Not a problem at all. Give me 1 second here. So for those tuning in, we're streaming live. So as always, if you have any thoughts or questions you want to put up there to Jeff, feel free to put it in the chat and we'll get to it while I bring up this graph here. But here we have the chart you're referring to here.
So I hope it's large enough for people to see. So if you go back to around 2013, when the money printing was vertical, well, look how flat that looks today in comparison to Jerome Powell's insanity, and look how small it looks. Yeah. So you see, the money printing that took place from 2009 to 2013 was vertical and extreme. It looked just like what we're seeing today, except today's money printing is so much more extreme that what happened from 2009 to 2013 now almost looks just like a blip.
Right.
And of course, and you talk about how quantitative easing stopped for a while. Well, please tell me in that chart where it stopped. Because this is something else that I was probably talking about last time I was on, is the myth that of tapering. Yeah. That they could talk all they want about it, but so the problem when you get into an exponential curve, is that's the mathematical representation of out of control. So, once you're out of control, you don't get back into control, and in the case of money printing going out of control, there's only two eventualities. Either you put the brakes on things and everything implodes, or you just keep your pedal on the metal because you have no other choice. And eventually you have a blow off top, and that's hyperinflation. And so, of course, that's where we're going, and so, of course, I was talking about that back with the previous surge of money printing, and we didn't see it.
Right.
And so, people may be saying, well, this guy's got no credibility. Well, why didn't we see it? Okay, so what happened is you had this massive inflow of new currency creation. And then, of course, remember that the big banks are able to multiply this new currency, with their reserve reserve ratios, fractional reserve banking. So massive quantities of new fiat currency hitting the system, but the vast majority of those new dollars were sequestered, because in the great financial crisis, the crisis was almost entirely located within the big banking and the banking system itself and the derivatives market. So all of these billions and trillions were flowing into putting out the fires in these markets, which are quite internal and contained. And so, in other words, this massive flow of new currency did not go into the broader economy. And so, of course, it's when the currency flows go into the broader economy that you get the inflationary pressures.
Yeah. Now, I'm curious to get your thoughts. So we now have just this past week, Jack Dorsey, the Twitter, CEO and Square's CEO, made a simple tweet. The U.S. is heading towards, hyperinflation or something like that, and it started trending all throughout the internet. A lot of people got excited, and not a mainstream news source is now debating and talking about or arguing as to whether or not we're heading towards hyperinflation. And then Kathy Woods, the ARK Investment CEO, came out and said she countered that with the narrative, with the idea that deflation is where we're heading, probably before hyperinflation. So inflation, deflation, clearly the currency has been created, and according to the definition, exponential currency ultimately leads to exponential price rises as well at some point. But overall, do you think the Federal Reserve is fighting deflationary pressures because of this too much debt that's imploding, and how it has a way of just bringing down asset prices rather than continuing to inflate them things the way that they need it to go? So inflation, deflation, why are they arguing amongst that? That's just more of a distraction in your opinion.
So I'm sorry, I can't really be respectful towards anybody who argues deflation, because to take that position, you have to make several fundamental mistakes. You have to fundamentally misunderstand history or simply be unaware of it. You also have to have a fundamental misunderstanding of basic economics, and then it's even just simply the common sense factor. So the bottom line is that insolvent economies can't deflate. And the dynamics are really simple. So what happens when an insolvent economy like the United States or like Canada, where I'm based, or the UK or most of Europe, what happens when they suffer a contraction? Well, tax revenues go down, spending goes up to try to plug the holes.
Yeah.
And these are economies that already have massive deficits. So what do we see? We see what we saw with the GFC, the Great Financial Crisis of 2008. The money printing goes vertical. That's the only option. So you see, the people arguing deflation today, they look back towards the Great Depression. And it is such a flawed comparison in so many ways, primarily being that back at the time of the Great Depression, all of our economies were very strong and solvent. And solvent economies can contract. They can have recessions and they can have depressions because they have financial reserves they can cannibalize. But insolvent economies have nothing to cannibalize, so the reaction to any sort of economic pain is print. And of course, printing is inflationary. So that's the only dynamic here. And so the other thing is, I don't want to take credit here. So the master for everybody is John Williams. And way back in 2004, I think, he came out with his fabulous essay, The Hyperinflationary Depression. And that was the textbook that everybody should have been reading off of. I read off it, I learned it, and I understand the dynamics now. And so I profess the same things. And the whole point is that you can have deflationary events occurring in a hyperinflationary environment. And specifically, bad debt can go to zero. Bubbles can go to zero. Ponzi schemes can go to zero. Even in hyperinflation. There's nothing stopping fraud from going to zero. In hyperinflation.
Yeah.
But the underlying dynamic is hyperinflation. And I would go a little bit further than John Williams and say that if you look carefully at all true hyperinflationary episodes, that they're all hyperinflationary depressions. Healthy economies never hyperinflate. The economy has to be really, really sick before the bankers running the monetary system get desperate enough to engage in this reckless currency creation to try to bail themselves out. So, hyperinflation is a inflation/depression event, but the inflation dynamic is by far the dominant one because, like I say, insolvent economies cannot actually deflate.
Okay, great point there. So hyperinflationary depression is something that can play out. So here's a question here. So as always, we're streaming live with Jeff Nielson from Dynamic Wealth Research, former guest here on RTD. Well, analysts, very smart individuals. That's why I'm glad to have you back on. So here's a question out here that I'll put out. It says from Timo, says, will the newly created money make its way to the economy? Question. If so, how long does it usually take?
So, and this is what I was sort of getting towards when you sort of got onto the other stuff you wanted to talk about. So, what we're seeing with the Powell spike in money printing is a different scenario than we saw after 2009. Now we're seeing a lot of this new funny money going straight into the general economy, and so we are seeing the inflationary pressures. And so, getting back to the comment you made about Dean Dorsey of Twitter. So this is another really important factor. And something I talked about before, and I'll talk about it again. So hyperinflation is always a confidence event. And what I mean by this is, in fact, if you look back at hyperinflations, the fundamental value of the currency becomes worthless long before the exchange rate plummets down to that level. And the gap between the currency is actually worthless. And when the exchange rate falls to zero is the confidence gap. Because when a currency first becomes fundamentally worthless, people are not willing to accept that. There's normalcy bias at work here. Our currency is not merely the bedrock of our commerce. It's sort of a fundamental of our lives, and the idea of something that we rely on to such a great extent could suddenly become worthless almost overnight is just too horrible to comprehend. So at the time the currency first becomes worthless, nobody can even conceive of such a thing. So this is why, when I was talking hyperinflation back in 2008, 2009, nobody else was, other than, of course, John Williams, who led the parade, because it was something they couldn't conceive. Well, so what are we seeing now? Today, we're seeing the H word getting used a lot, and all over the place, not just, people analyzing markets, but corporate executives, and I read this one article talking about how just mentions of inflation in corporate boardrooms had gone absolutely vertical. So this is a signal that the confidence crisis has started, because the moment you mention hyperinflation, you're implicitly expressing a profound lack of confidence in the U.S. dollar, because hyperinflation means dollar goes to zero. Yeah. So there's no more lack of confidence in the currency than saying we might be seeing hyperinflation coming. That's the death of a currency. Yeah. So people start talking about the.
So let me throw a curveball at you just for old time's sake. And so outside, okay. So when we talk about hyperinflation, we currently have the current world reserve currency right now, and then also there's overwhelming majority of the debt outstanding beyond this country is denominated in that same currency. And then there's a lot of countries having a dollar liquidity crisis because they need more units to pay back old debt. So is there a position to where there's not enough dollars currently? I mean, we do have a large supply. We see the graph here. I can put that back up, and we see what has been created. But as far as what's needed to pay off and to keep things sustained, as far as trying to repay back the debt, i.e. the whole China situation, they need dollars over there to pay back those dollar debts. And so there's still more dollars needed. And could that buy more time to actually prevent that, lack of confidence event, probably domestically, because the world still needs dollars? Or is that not something is likely, or what?
No. So of course, that's see, you're presenting an argument that the establishment loves to roll out.
Okay.
And of course, for so many years, it was true. The US dollar was overwhelmingly the reserve currency, but it is no longer overwhelmingly the reserve currency.
Right.
Most of Asia's economies now use the yuan as their reserve currency. And so, I don't have an exact ratio handy. I wasn't sort of anticipating this particular question, but I think you could probably talk about sort of like, 2/3 dollar, 1/3, renminbi now in terms of currency usage.
Yeah.
And of course, see, this has been a huge part of what China has been doing in the financial markets over the past 15 years now. So people constantly talk about how much treasuries China's holding, how much dollars China's holding. But so they're not fully presenting the story here, because China wants to phase out the dollar as reserve currency because that's taking a big stick out of the US's hands.
Right.
So what has it been doing? It's been doing currency swaps and bilateral trade agreements right, left, and center, mostly in Asia, but also in other countries and continents as well. And so these currency swaps are basically taking dollars out of circulation in trading relationships and replacing them with renminbi.
Yeah.
So when you see China accumulating dollars, accumulating US treasuries, this is because it's been draining the swamp. And so it's ending up with these paper assets on its own balance sheet. And of course, it gets rid of them, as fast as it can. So it doesn't want to get too heavy in dollars because it knows where the dollar is going better than anyone.
Right.
But it needs to be an intermediary to be draining the swamp, taking dollars, handing out renminbi, and then every time it does one of those currency swaps and bilateral trade agreements, that removes the dollar from the picture permanently. So if you want to look at the real source of fanatical hostility that the US is currently directing towards Russia and China, it's not geopolitical, it's economic. Because Russia and China, of course, mostly directly, but Russia somewhat, indirectly, are the leading engines in the de-dollarization of the global economy, taking that final linchpin of support out of the dollar that the establishment likes to trump out that you were just talking about.
Right.
And so, so this is the whole thing. So basically, Russia does almost all of its energy trade now in rubles or renminbi, and that's a big hit. So because of course everybody knows about the petrodollar and all of the regimes in the Middle East that were knocked over because they threatened the petrodollar system. So so for precisely the reasons you mentioned, de-dollarization is viewed as a huge threat to the U.S. and its overlords.
Yeah.
Because it exacerbates the oversupply.
Right.
So, the net dynamic today is not people needing to acquire dollars. It's people divesting themselves of dollars.
All right. Now, another question. We got some questions here. As always, we're streaming live, so feel free to throw out some questions to Jeff. I would love to get them to him. And so one thing that's different and that's from prior events or monetary resets is that, of course, everyone always runs to gold. Of course, China, Russia, the BRIC nations, they've all been, getting gold at an alarming rate over the last 20 years or so. But then, of course, there's the throw in just the Bitcoin into the equation. The mainstream narrative and everything on the mainstream circuit is about Bitcoin. El Salvador has on their balance sheet. And so when Jack Dorsey mentioned the whole hyperinflationary quote, the first thing I read within a little thread there was that he's also referring to Bitcoin, how Bitcoin will be a beneficiary of all that liquidity at some point, in the same point as gold. So what are your thoughts about that? About Bitcoin being an equation now rather than gold?
So I have a lot of thoughts about this, and it's going to take me a while to sort of get it all out here. So let's go back to the beginning, because when the cryptos first came out, a lot of my smart friends in precious metals were really excited. It's like, okay, this is independent of the financial system. It's a threat to the conventional banking.
Yeah,
it's going to replace, these fiat currencies. So, did none of these people think the big banks were listening? I'm a strategist. I'm a games player. Strategy games have been a passion of mine for all my life. So whenever I'm confronted with a problem, it's like, okay, how do I achieve victory?
Yeah.
So I'm running. I'm part of the big bank oligopoly, and I'm hearing all this talk about independence and threats and replacing, and it's like, okay, am I going to sit back and do nothing when I'm sitting with virtually infinite quantities of funny money to deploy, to solidify my position?
Yeah.
No, I'm gonna do something to neutralize this threat. And what could be more easier and obvious to neutralize the threat of cryptocurrencies than for the big banks to control the supply themselves?
Yeah.
So this is the whole thing. So and this explains a lot of the dynamics people have seen. So a new cryptocurrency gets launched, hockey stick.
Mm-hmm.
Why? Well, because the big banks want to get in first and lock up the supply.
Yeah.
And then after the cryptocurrency has its initial hockey stick, what do we see? Volatility.
Mm-hmm.
Well, why do we see the volatility? Well, because the only way that cryptocurrencies can really be a replacement for the fiat currency system is if they are stable enough to be a reliable medium of commerce.
Mm-hmm.
This cannot be a big factor of commerce because no company can afford to have those sorts of currency fluctuations on their month-to-month operations. It would create absolute havoc trying to run a business.
Mm-hmm.
So when you see the volatility like that, I mean, that's an invisible hand at work. And then, of course, we have El Salvador going to the extent of saying, okay, we're going to make Bitcoin a legal tender, which should have been a very bullish event for Bitcoin. What did we see? Pshoom. Who would have wanted to have Bitcoin go pshoom when El Salvador made it legal tender? I mean, this is pretty obvious stuff. So people are saying, well, where's Bitcoin going to go? Well, of course, it's a bubble. Like where did tulip mania go? Well, people were buying houses with tulips before the bubble finally crashed there.
Yeah.
So cryptocurrencies are a bubble, and so the other thing is that offends me is when people talk about cryptocurrencies as some sort of hedge against inflation.
Mm-hmm.
So the only thing that can ever hedge against inflation is a hard asset, because the idea is no matter what ravages of inflation you have, an ounce of gold is still an ounce of gold when the dust settles. An ounce of silver is still an ounce of silver. A barrel of oil is still a barrel of oil. A bushel of wheat is still a bushel of wheat.
Yeah.
Bitcoin is just this, gambling token, because they're not currencies, they're gambling tokens, digital gambling tokens. And so you can talk about the supply of Bitcoin being finite. But when the number of cryptocurrencies themselves is infinite, then you no longer have any restriction in supply. If tomorrow somebody can always go out and create one more cryptocurrency or 10 more cryptocurrencies or 100 more cryptocurrencies, sooner or later you get supply grossly overwhelming demand. Mm-hmm. And then you're going to see, first, one and then more of these cryptocurrencies, have their supply crash.
All right. Now let me ask you a question. So outside of Bitcoin, of course, Bitcoin is the main item that they want us all to focus on. But then you also have the decentralization of finance in general through all types of other protocols where the banks are, definitely jumping in. They want a piece of the action for profit's sake, as well as this whole great reset, transition us into this this utopian type of society where they'll own everything and we'll own nothing. And of course, everything will go through an app or some kind. Then we got the CBD, central bank digital currency stuff coming out as well. So all that technology is being used at a time where they want to transition humanity towards basically a digital ID and everything like that. So do you see any use case for any of these projects from a financial standpoint that offers value to the marketplace, given the fact that I can send currencies a lot faster via the Lightning Network on Bitcoin than I could using the SWIFT system to try to get money, factor in the remittance payments and things like that, and all the things that it's designed to try to solve in a sense.
Yeah, no, this is just weaponizing the financial system. Mm-hmm. And anytime the banking cartel wants to push through some major change, they always cloak it in this efficiency game.
Yeah.
Short selling was supposed to make our markets more efficient. Well, it didn't exactly work out that way. Trading algorithms were supposed to make our markets a lot more efficient. Well, what do we have today? 80% of the trading is algorithm trading, computerized price fixing.
Yeah.
Because that's what a trading algorithm does. It fixes prices.
Yeah.
And if you look deep enough in these algorithms, you will hear that the trading patterns of these algorithms are correlated. Mm-hmm. As in, there is one invisible hand working these algorithms, marching markets up and down at their whim. Because when 80% of the trading is algorithms, it drowns out everything else. And so we don't have markets anymore. We have computerized price fixing operations thanks to the efficiency of the trading algorithms. And the efficiency they want to add to our monetary system is just going to be more blights on humanity.
Yeah. Now, so we're streaming live, so feel free as always to throw out some questions in the chat. I would definitely love to jump on it. So let's get into gold and silver. And so gold and silver right now, there's every asset class, every commodity for the most part has reached all-time highs except gold and silver, doing a lot better than several months ago, but yet nowhere near where they should be in a reflection of all this currency creation. And so you got, future manipulations, all types of things going on. At what point will it break, do you think? Because everybody's been, last 10, 20 years, gold, silver, gold, silver, gold, silver. But a lot of people have lost interest due to the invention of this new stuff that is starting to move. Give us some ideas as to, what should we expect with gold and silver in the days ahead?
Well, one of the reasons I started smiling as soon as you mentioned precious metals and then cryptocurrency is because the bankers are smiling.
Yeah.
Because the cryptocurrency bubble has sucked away so many investor dollars that would have otherwise gone into gold and silver. Mm-hmm. And it's taken so much of the heat off them in terms of the supply pressures to their market. So this has been a major factor in the fact that we haven't seen even a fraction of the appreciation we should have seen in precious metals. And of course, the other thing that was a huge factor, and I didn't realize it originally, was that with all of the the pandemic and the lockdowns, so the big gold buying nations, China and India, their people were shuttered indoors, for the better part of several months, not buying bullion. Mm-hmm. And that's the major source of physical demand. So even though we saw a surge in demand for physical in the West, relatively brief. I mean, and it's still elevated, but not to the extreme level we saw, say in March in April of 2021. Mm-hmm. But the extra drop off in China and India demand more than compensated for that, and it's left the bankers able to continue to play their games.
Yeah.
So when is it going to end? Well, I saw an interesting interview from Andrew Maguire, who, of course, is much more informed on the gold and silver markets than I am, mm-hmm. and he's quite convinced that some changes that are going through in the Basel banking regulations are going to should put an end to the paper market in the sense of it being separated from the physical market. Mm-hmm. So if this unfolds the way Mr. Maguire says, and like I said, he's a very credible source, then that could be the trigger point right there. If not, I'll go back to basically what I've been saying before myself, going right back to when we went into the long slump starting in 2011. Mm-hmm. Basically, the only thing that can break precious metals free from that's chokehold that the bankers have because of all the manipulation techniques you alluded to mm-hmm. are either a serious crash in the market, an inventory default, or a true decoupling. And so, the crash, we saw that, in March 2020, we saw that in 2008. They pushed prices down too low. There's a boomerang effect. Even the algorithms can't contain it, and you see the big rush. Mm-hmm. Of course, if there's a formal default, that's also game over because the bankers can leverage the dwindling quantities of metal they have to an almost infinite degree, but they can't leverage zero. So a formal inventory default, it's game over as well. The third way the game ends is through a true decoupling. So we don't necessarily have to have a formal default, but and so we started to see this back in 2020, early part of the year. Mm-hmm. So when we had the crisis with people not being able to get their hands on bullion, we saw a disconnect.
Yeah.
So we saw the people paying basically, in the case of silver, as much as double the spot price. Mm-hmm. That's not a premium any longer. Double is not a premium. Double is a separate price. So that was the beginning of the decoupling of physical silver from paper silver. Mm-hmm. And of course, fortunately, they were able to recouple because, mm-hmm. as we just discussed, the demand pressures eased when China and India were forced into lockdown.
Yeah.
So so these are the trigger events that will lead to a major breakout, or simply enough people getting heavily motivated in terms of bullion buying. And of course, you alluded to China and Russia, mm-hmm. the huge bullion accumulators. So that's, of course, another massive source of U.S. animosity towards those two nations is the fact that they are putting the pressure up immensely by their own accumulations. And of course, because China and Russia are well regarded in the world, we see a lot of other nations saying, well, gee, we should get our our own gold too, and they're also adding, so Poland's going on a big, gold buying binge, even though it's officially within the Western sphere.
Yeah.
It's, there's a lot of dynamics in play that could do this. What exactly is going to be the trigger? Nobody can really say at this point, unless you're confident in Mr. McGuire's analysis.
All right, good point. So we do have some questions here. I want to make sure I get to those. So we have a question from Lala here. It says, does Jeff think that when the market crashed, that gold will be banned like in the 1920s?
I've been outspoken since day one about the danger of confiscation, because we know that our governments have basically squandered their own gold. So, and then there's the golden rule. He who has the gold makes the rules. So if they want to make the rules again, what are they going to do? Try and get their hands on more gold. So this is why, I say, don't ever, purchase a bullion account. And of course, I also say stay clear of the ETFs, because see, if there is confiscation, anything that's in an account or an ETF or a fund of any kind, it's point and click, and that bullion's gone.
Yeah.
So the bullion that people, store at home or, in other locations or foreign storage, that's not as easy for them to get their hands on.
Yeah.
They can demand that we surrender it, like they did in the 30s. After people have been burned once, how do you think that's going to work out?
Yeah, good point.
So the people who are holding it are not going to be very willing to surrender it, even under a threat of sanctions. So for the gold that people are holding physically, if they want to get it, they're going to have to send their Nazi thugs to bust down people's doors and punch holes in people's walls. And are they willing to go to that extreme? Are they willing to lay their fascism that naked for everyone to see? So, so my hope is that they'll draw the line there, because also, so the other factor is that, probably the majority of bullion being held in the West is in ETFs. It's in these accounts, in these funds. So they do the point and click, and they've got most of it. So maybe they say, well, that's good enough. We don't need to be, bashing people's doors down and busting holes in their walls. We'll just take what we can get easily and leave it at that.
Yeah, we will see. That's never. I mean, it is what it is. And so one of the mantras here is to get your weight up, and of course, we encourage people to prepare in a variety of ways beyond just the financial side, because we're also witnessing the supply shortage issues and things like that. So they're throwing a lot of obstacles at us right now. And I think this all has to do with the greater agenda that the World Economic Forum, Klaus Schwab, all those individuals came out saying what they would like to do for society. And of course, we got the Build Back Better mantra as well in this country. And so, given the fact we're 2021, where are we heading, in your opinion, this next decade, within this next decade, based upon what you see, best case scenario, worst case scenario? What do you think might unfold?
Well, so I mean, whether you want to call it the deep state or whatever you want to call it, for me, I look at a pretty incompetent operation. And, it traces back to the simple fact that, this is basically a monopoly. And, one of the things monopolies are notorious for are being incompetent and inefficient. So, what we've seen with this deep state or whatever people want to call it, is that, they have all of these diabolical schemes, but, they never tend to work out as well as they hope,
Right.
And, I mean, one of the examples I always love to sort of point out in poking fun at the ineptness of these of how inept they can be is their schemes to steal the gold from the people of India. And so the first one was they thought, okay, well, we're going to roll out our paper called gold products to India, so that instead of buying bullion, everybody's going to go out and buy bullion ETFs. Not realizing that, the 800 or so million Indian peasants who don't even have access to bank accounts weren't going to be buying bullion ETFs.
Right.
So, that scheme failed. So then they got the current corrupt government in India to announce a gold deposit scheme. So, of course, what do we hear from the bankers when they want to disc gold? They say gold pays no interest. So that's why nobody should hold it.
Yeah.
So here we have the government of India announcing a gold deposit scheme where they're going to pay interest on the gold that the people deposit to the government. Well, gee, where is the interest coming from? So people kept asking, and the government goes, well, I guess we're going to have to sell some of the gold to pay the interest. Well, as soon as that came out, the gold deposit scheme went pashoo. So I mean, these people with almost infinite power and infinite access to information resources, come up with sometimes the stupidest ideas, and sometimes the schemes they try to implement are just destined to fail. So for me, I can see where they're going. Full fascism. One world government. No cashless society, so that we're total hostages economically. But I think the fact is that their house of cards is collapsing so rapidly that they're not going to be able to execute. And in particular, they're not going to be able to execute because of the shifting power to the east. China, Russia, the Belt and Road Initiative, the multipolar world. The phrase that they don't want to ever hear, multipolar world. Yeah. And so they're, that's the track things are heading. They're losing their influence. People are seeing these nations, for the fascist, corrupt, hateful regimes that they are. Yeah. And so, this is why, like China and Russia aren't perfect nations. China in particular has, it's no shortage of flaws.
Right.
But, compared to the West, the world is gravitating towards these powers because they're seen as more honest brokers than we are.
All right. Now, given some of the things you mentioned, it looks like based upon all the things that's thrown at us, it may not succeed, which is great. And so as far as strategizing how to navigate these waters moving forward, some asymmetric plays or whatnot for dollar risk, of course, gold, silver. What else are you, from a financial standpoint, would you consider being some good plays in the days ahead as far as opportunities that might come about?
Well, so, prior to us starting the show, I mentioned something I've been really involved in for the last year and a half, which is the psychedelic drug industry. Mm-hmm. So I was telling you a little bit about it. So we've got this massive mental health crisis. Roughly 2 billion people, roughly 1 in 4 people around the world has one or more treatable mental health disorders that are generally untreated because mental health care is so pathetically inadequate. Mm-hmm. And the psychedelic drugs that have been heavily criminalized for 50 years are literally miracle drugs in treating mental health disorders, whether it's depression, post-traumatic stress disorder, addiction, miracle drugs. Mm-hmm. And so we've got this unprecedented health crisis. So as I've written before, the mental health crisis dwarfs the mental health pandemic, dwarfs the COVID pandemic grossly. Mm-hmm. For every active COVID infection in the world, there are roughly 100 people with mental health disorders. Mm-hmm. So I mean, that's the biggest health problem in the world today, and it's having a huge impact. So the U.S. is having their labor shortage. Mm-hmm. Well, maybe if there wasn't 40 to 50 million otherwise employable Americans on the shelf with mental health disorders, they could fill 11 million jobs. Yeah. Mental health disorders are the leading cause of disability. Mm-hmm. And of course, since COVID, with stress going through the roof, and rates of depression and post-traumatic stress disorder and addiction going through the roof, mm-hmm. we have less and less healthy workers. Yeah. So, this is why, all this talk that as soon as the government, cut off its COVID benefits, that, the people were going to flood to claim all of these low wage jobs. Mm-hmm. And instead, most people ever quit in August.
Right. I saw that 4 million people.
Yeah. People aren't going to work for minimum wage jobs. It's all there is to it, especially when the sick people maybe have to commute like an hour or so each way because they can't afford to live in the city where the jobs are located. Yeah. So, like 12-hour days for minimum wage while you're grappling with mental health disorders that aren't being treated because these psychedelic drugs are being kept on the shelf. So I'm, not only heavily involved in working in psychedelic drug industry, I'm personally invested in it. And, as far as stocks go, almost to the same extent as precious metals, because these are the only path forward for a mental health crisis affecting 1 out of 4 people. It's cures versus crutches. So these stocks are currently just as beat up as precious metal stocks. So my portfolio doesn't look very good today, but I'm very optimistic in where it's going. And so talking back up a bit about overall strategy. I mean, the bottom line is people should be playing defense. We're at a time of unprecedented risk and uncertainty.
Yeah.
Well, obviously, that's a time for defense. So defense means you don't chase bubbles. You don't pump more money into real estate. You don't pump more money into Apple or Tesla or Amazon. You don't pump money into cryptocurrency bubbles. You get into precious metals, which are priced at pennies on the dollar, mining stocks, pennies on the dollar, psychedelic stocks, pennies on the dollar. Because, it's not that these things can't go lower when there's a crash, but coming out, what's going to go up furthest and fastest?
Yeah.
We're looking coming out of the failure of our monetary paradigm. We're looking at something resembling honest money. So in that world, how can gold and silver not be, leading asset classes? And I mean, of course, if you actually look over the past 50 years, gold has been a leading asset class, as much as the bankers hate to say it.
Right.
So, it should have even a brighter future coming out the other side of this hyperinflation.
Wow, that's that's something worthwhile there. So psychedelics is definitely something I haven't dived into much, but I'm definitely curious to do that. And so moving forward, the trying to prepare for the uncertainty, but also taking advantage of all the opportunities that will present themselves, because outside of the chaos, I remember one of the quotes, I'm not sure where it's from, but is also often referred to that like during the last Great Depression, there was a lot of millionaires made as well. Not everyone lost everything. So just got to look for those plays to take advantage of and hopefully be on the winning side as all this stuff kind of blows through, I think.
The other way to look at that is, so if you go to Europe and you look at all of the different peoples of Europe, only one of them really have any sort of cultural attachment to precious metals, and it's the Germans. And in particular, they like silver. Well, why did Germans have an attachment to silver? Because there is still cultural memory in Germany of the Weimar hyperinflation. And so, it wasn't necessarily a matter of the people having silver being millionaires, but the people who had silver survived the hyperinflation relatively intact. And those who didn't, game over economically. Wow. So it's not necessarily, playing defense, it's not about getting rich. Playing defense is about survival. So it's like, how do we survive this? Because, we're coming up against an economic catastrophe that's beyond anything like anything that we even can talk about in our recorded history. We're any a major super cycle. We're apparently heading towards a revolutionary cycle. And, the last time we had relatively primitive economy. So our modern economy has never entered a period of upheaval and uncertainty like we're about to go into right now. So, maximum defense, bullion, the ultimate safe haven. And then, the stocks that you like, that you personally like, coming out of the crisis. And, those are the ways to prepare yourself. But, hard assets. So, if a friend of mine, he's got a passion for art. So he, collects art. Well, that's going to have value coming out. It's a hard asset. Real estate. Let's take a moment about real estate, because this is so important.
Yeah.
Real estate has typically been seen as a safe haven. It's no longer a safe haven, and not simply because of the bubble prices. It's because real estate has been turned into a Ponzi scheme. Because people think about real estate two-dimensionally. There's only so much surface on the earth, limited supply. Not anymore. Not since they started building to the sky.
Right.
So, in a one-story world, real estate's always going to be a safe haven because of the limited supply argument. In a 30-story world where the units keep getting smaller and smaller, and so this is the huge danger in real estate today, because the entire paradigm of the market is based on a massive fraud. Because when they're talking about supply demand, it's numbers of units for sale versus how many are being bought. No. Housing units have utility for only one purpose: living in them. So we have this massive increase in supply, like ridiculous numbers of new, developments going up,
right,
and no one to live in them. So, for instance, if you look at that horrible catastrophe in Miami, where that condo building collapsed,
right,
40-year-old condo building, less than 60% occupancy.
Really?
And that was a 40-year-old building So, this is a building that middle class people can afford to live in. So it's not just, rich people and snowbirds. This is a middle class building, less than 60% occupancy.
Yeah.
And of course, the new buildings we know, are notorious for building, being like, half occupied, maybe 2/3 occupied, because of all the foreign buyers and speculators. So we look at the real estate market today, and you see home buyer sentiment at basically all-time lows, whereas home builder sentiments at all-time highs.
Mm-hmm.
Well, how can you have a disconnect like that? If the buyers are out, how can you have the home builders so pumped up? Because the only people in the market are the speculators, mm-hmm. because they don't understand. They don't understand this is a Ponzi scheme now. They're still in this two-dimensional world, finite supply. I'm going to get in on this finite supply because it can only go up. Well, no, not if there's three housing units for every housing, every family.
Right. And then also during the beginning of this whole lockdown situation and coming out of that, we saw like BlackRock and all the, big hedge funds coming in and buying up everything. And so I think just recently, I think Zillow, mentioned that they're going to stop buying or something like that as well. So as a part of the buying spree that all those entities went on, a part of the agenda that they put out there is that, you own nothing to be happy with it. So turning homeowners into renters itself seems like it's a part of their plan as well. So take anything that is available and semi-affordable off the market, and so they'll be able to rent it out as an income property for themselves. What it looks like it might turn out to be.
So you mentioned that, and whenever I hear somebody express that sort of a thought, mm-hmm. I flash back to the Banker's Manifesto of 1892.
Okay.
And a line that always stands out at me. And it goes like this: people without homes won't quarrel with their masters. Mm. So yes, dispossessing people of home ownership is a huge long-term scheme. And when we're talking long-term, as in from 1892 to the present.
Yeah.
And so, for instance, so the big U.S. housing bubble, 2005 through 2007 that blew up, mm-hmm. that was to some extent a trial balloon, for how efficiently they could dispossess people of their homes. Mm-hmm. And so, one of the things they found out to their chagrin is that, due process was really hampering their style in, yanking people out of their homes and throwing them out on the streets, mm-hmm. because people, they actually wanted to have hearings when they were being foreclosed on.
Yeah.
So they created these foreclosure mills, where they brought retired judges, that were, basically, Joe Biden's, with robes on,
yeah.
and, half asleep behind the bench, rubber stamping what was ever put in front of them. And even with the foreclosure mills, they mm-hmm. couldn't come close to yanking people out of their homes as fast as people were going underwater on their mortgages. Mm-hmm. So, this can't be sort of like a one and done thing where, like they have one big take and then everybody's homeless. It has to be, a series of waves. Yeah. So, bubble up, crash down, bubble up, crash down. And every time the crash gets down, a larger percentage of people get permanently out of home ownership. Mm. And of course, if every time you come out of the crash, the prices jerk up so quickly, those people that were pushed out never get a chance to get back in, because as soon as they're even thinking about home ownership again, they're already out of the price range. Yeah. So that's part of it. But ultimately, because the other side of it is allowing these real estate bubbles to run wild has allowed the establishment to create an illusion of economic health. Construction jobs, all of this commerce, because real estate generates a lot of related commerce. Real estate agents, along the chain, people, furnishing homes for the ones that are actually occupied, et cetera, et cetera. So a housing bubble is a wonderful way of creating an illusion of economic health. And so if you create by far the biggest bubble in history, you're going to create by far the biggest illusion. Mm-hmm. So, this is why our economies are so much sicker than people think, because you have this one area where the economy is ridiculously overheated, and most of the rest of the economy is ridiculously sick, and they push the two together and they go, well, we're pretty healthy. Well, no, it's not like that.
So watch this. So when this current bubble pops, as well as all the other asset bubbles pops, how long of duration should we expect a depressionary style, recessionary style of event to occur? Because typically it drops and comes back. I mean, the cycle has been normal over the last couple of years, apart from the great financial crisis till now. But they've extended things so much as far as this artificial nature of everything. Does that mean it's going to be an artificial, prolonged recessionary depression type of event as well?
Well, so remember, we're committed to the hyperinflation side of things. You know, anything deflationary is a secondary incidental consequence of the hyperinflation. So you know, ultimately, it's blow off top. You know, so this is why I'm still in stocks. You know, even though I'm alarmed at how dysfunctional our markets have become, because you kind of have to be. You know, because like the stocks themselves are paper instruments, but the companies behind them are generally representing hard assets. And so, you know, like in a hyperinflation scenario where currencies go to zero, your markets may cease to trade for a period of time. But you'll still hold the equities, you'll still hold those interests in the corporations. And when they, you know, repair, you know, and get a new monetary system back up and running again, you know, then, you know, you'll still have those assets. And then they'll start to recover. You don't want to be in bonds. You don't want to be in cash, obviously. You know, you don't want to be in anything that's pure paper, because pure paper is going to zero. All the pure paper is going to zero. And I mean, you know, the most ridiculous of all the bubbles, of course, are the bond bubbles. Because, you know, so first of all, back when we had legitimate bond markets, interest rates were a function of risk. The more risk, the higher the interest rate. And that was true even with the US economy, you know, back when it had a legitimate economy. You know, when its debt started to look a little bit worse, the bond rates crept up. Well, now, of course, we have bond price fixing, where the central banks, you know, print up oceans of their funny money and they buy up each other's bonds. So there's no price discovery of the bonds. So you have the riskiest bonds in the history of our nations at the highest prices in history. You know, so that in itself is a ridiculous bubble. But then these bonds are denominated in worthless currencies. So, you know, the currencies themselves are worthless intrinsically. The bonds are doubly worthless because they're fundamentally worthless. They're the debts of insolvent debtors, and they're denominated in worthless currencies. And they're trading at the highest prices in history. You know, what could be a more massive fraud than that?
Very, very true. Now, so on the, as we get ready to draw back on the interview, housing prices, like, you know, so they can't go up forever, or can they? Because they're denominating currencies that are worthless. So Venezuelan real estate right now might be doing really good nominally, but as far as what the average person can afford, there's nothing happening there. So moving forward, slight crash, as you mentioned, in the equities, but then usually things pick up from there. With the housing market, do you think, because we're all, you know, in the highest housing market ever, so is this sustainable for a long time, or does it have to correct to what the average person can afford? Especially, you know, factor in that the, you know, banks and the lending will definitely not be available or as plentiful as it has been. Then what? How do we price the housing at that point?
So the fundamental principle of all housing markets is that over the long term, housing prices must remain parallel with incomes, because you service your mortgages with your income. So what we've seen in particular the last 15 years is housing prices going like this and incomes like this. So, you know, you've got this, you know, the largest disconnect in history. We know the incomes aren't going up. So, you know, the largest disconnect in history can only be corrected by the prices going way down. And of course, what makes this housing bubble far worse is what I was just outlining before, that it's a Ponzi scheme now, that we have, you know, all of this massive amount of excess supply beyond anything we've ever seen in history. And so you know, here's a question for you. What is the value of a housing unit that will never be occupied?
If it'll never be zero, well, I wouldn't say zero, but it's damn near, it's extremely low. Extremely
and in
low.
fact, if you go out of the last housing bubble, so the last housing bubble was different from this one, because that was a lateral bubble. That was still the U.S. expanding, you know, way out into the quote unquote suburbs. So when that bubble ended, and they also ended up with excess supply, they actually ended up bulldozing large numbers of brand new houses. They never ever had an occupant, 100% write-offs. Well, now we've got all of these ghost apartment buildings that are never going to be more than half full, maybe 2/3 full before the crash starts. And then when people have to pull in their horns, so of course, and the speculators are so ridiculously leveraged. So this is another reason that I laugh whenever I talk about interest rate hikes. Right. They're really going to, put the screws to the real estate speculators when they're so ridiculously leveraged to low interest rates, and of course, the corporations borrowing, trillions of dollars to buy back their own shares to pump them up to bubble levels. Well, what are they going to think about higher interest rates when they have to pay interest on that debt? I mean, so they talk about raising interest rates. Well, so it's desperation jawboning to try to lower inflation expectations. They're trapped. They can't raise interest rates. They can't stop the money printing. They can pretend they stopped it like they did in 2015, but it's still going to keep going up. They just lie.
Oh, my goodness. Well, Jeff Nielson, I appreciate you for joining us here on RTD Q&A. You definitely answered a lot of questions from the viewers as well as the questions I had as well, just to better understand what's going on. And for those that are tuning in, I appreciate you guys for throwing out those questions or whatnot. Can you point back to where you do your writing and do your analysis work or whatnot so people can plug in and, be a blessing in your work?
Yeah. So, when it comes to the psychedelic drug industry, we work off of psychedelicstockwatch.com. And when it comes to precious metals, hard assets, and, more mainstream investing, that's dynamicwealthresearch.com.
Okay. So I'll put them up right here. So we got the Psychedelic Stock Watch here and then the Dynamic Wealth Research right here. So I'll put those beneath the video as well so people can plug into you as well. But once again, Jeff, it's been great connecting. It's been a long time since we've connected last, but hopefully catch us sooner this time, permitting schedule works out for you or whatnot. But thank you for joining us on this RTD Q&A, and definitely you answered a lot of questions. So I appreciate you for filling in the blanks and helping us navigate these choppy waters. So thank you for joining us for RTD Q&A.
My pleasure. Lots of fun.
All right. Well, everybody, hope you guys enjoy this. If you have, hit the thumbs up, share this, and definitely put this information out there so your family and friends can find out what's going on beyond listen to the mainstream news where they read off teleprompters telling you what you want to hear rather than what you need to hear. So other than that, be back at it again for live stream later this evening. See you guys later. Peace.